As you probably just saw with the red dot that popped up, this event is being recorded. So please feel free to, if you'd like to take notes, that's great. If you would like to have this as something to maybe come back to later and you don't feel like taking notes at this time, that's good too. This presentation is going to be up on our website. Let me just introduce myself first. My name is Ari. Will the PowerPoint be available for download? We did actually share the PowerPoint in the RSVP email. If anyone wants the PowerPoint that didn't get it, please, private message me your email and I can send that to you now, actually. So I'm one of the grad assistants for the Successful Start program, which is one of the financial wellness program at Boston College. It's focused on helping people learn more about finances, learn more about these different topics, and hopefully make it a bit less stressful for people, knowing that this is certainly something that can be very stressful. So we have two main types of programming. One is the Money Mentors program, where you can sign up to either be a mentor or be a mentee. And that's a nice kind of social interactive kind of thing where you can learn about these different topics and maybe even teach some people about these different topics. Something that's great on a resume and a real easy way to learn about these topics if you're not already familiar. We also have another side of our programming focused on lectures like the one that you're attending tonight. We've had several throughout the semester on a range of topics, including negotiating job offers. We also had earlier presentations in this lecture series focused on credit and loans, as well as investment basics. And this is the third and final part of the lecture series. You can also feel free to review all of these, including the first and second part of this presentation on our website as well. I'll post that in the chat shortly. But for tonight, we have the third and final part, which is focused on creating a savings and investment plan. And we are very fortunate to have a CFA and Boston College professor who has collaborated with us many times in the past, Edmund Ryan, here tonight. So I want to pass it off to Edmund and we can get started.
Hi, well, I hope you're all doing well. You're getting to the end of the line and the semester is going to end pretty soon. I'm not sure if I get a feel for this, but this is the third of three pieces in the program. The first piece is really standalone program. It's primarily on credit rating and what to do about it. The second one is an intro to investments. And the third piece, which we're going to cover tonight, is about diversification, creating an investment plan. Now that you know a little bit about investments, how do you get an investment program started? So I will start off with a little bit review of the second lecture. We're not going to go into as much depth as we did a couple of weeks ago, but it'll give you an opportunity, hopefully, to get up to speed. It's a fairly small group today. If you have any questions or you want me to go in a different direction on a topic, you can send a chat and Ari will be monitoring the chats and I'll monitor them when I have a class, or you can just ask a question. So we're small enough. If you have a question or I'm not particularly clear on something, then by all means, just jump in and ask the question. Okay, fair enough. So here's the agenda. Again, we're going to look at an investment review, look at different types of investments, talk about asset classes, talk about diversification. So how do you start to mix and match different investments and different asset classes? Talk a little bit about mutual funds or ETFs. Maybe you're familiar with that term, exchange traded funds. They're basically the same. Talking about starting a savings program. So when you can come out of here and you're lucky enough to get a job, one of the first things that company will do is ask you if you want to sign up for their 401k plan. So we'll talk about that too. So again, if you have any questions, you want me to speed up or slow down, again, it's a small enough crowd, we can do that. So what we have here, okay. what we have here are what they call asset classes. And if you're a business major or finance major, you probably heard this before, so bear with me. There are three primary asset classes, and those are over on the right-hand side. There's what they call money market, and that's primarily the government or companies borrowing money on a short-term basis, primarily to keep the business going. So if you're a company and you need to have inventory, you're a retailer, then you get the inventory in, you borrow the money to pay for it, and then when you get paid, you pay the money back, generally in the area of 30 days to 90 days. And you can invest as an individual in bank certificates of deposit or different types of money market instruments. We'll talk a little bit more about those. Bonds are designed to provide a little bit longer term financing. The government borrows money all the time, trillions and trillions of dollars out there, and they use that to finance the government. So you can, government bonds would typically run anywhere from short-term bonds are considered money market. Then they can borrow money for 2 years, generally up to 30 years, with most of the concentration in the 10-year range. So they're considered a little bit riskier than money market, but not as risky as stocks. The third asset class is domestic equity. The equity is ownership of a company. So if you buy one share of Apple, you are entitled to 1/300 millionth of voting rights and their profits. So that's ownership of the company. The returns are not guaranteed, but the fact that you own the company, a piece of the company, is guaranteed. We get into some more esoteric asset classes. So whatever we do in the US is also done in Europe, is also done in China, is done in markets all around the world. And if you're a US person, they call it international equity. And it behaves the same way as United States stocks. The difference is that the company that you're investing in is domiciled in another country. So you can own shares of Toshiba, which is a Japanese company. So that would be considered international equity. And then they have this vast other category, including real estate. And real estate, you can lend money in the real estate market, or you can own properties. Commodities such as gold and silver and oil, Bitcoin. I think you're probably all familiar with Bitcoin these days. Bitcoin is electric currency. Today it's trading at about $57,000 per Bitcoin. Bitcoin is getting more and more play. I note that some basketball players have signed $10 million contracts where they get half the money in US dollars and the other half is in Bitcoins. And then you can invest in any of these commodities through what they call futures, which we're not really going to get into tonight. Okay, so fundamentally then, a stock is an equity, it's ownership in a corporation. There's no guarantees. The price of that company, the price of that stock can go up or down. You as an individual investor participate in the growth of the company through price changes and distributions of earnings. As an owner of the company, you're entitled to 1/300 millionth of the earnings of Apple. And that's done through dividends. So they pay out the earnings through dividends. Obviously, the price can go up or down. And the goal long-term for equities is to return about 6% over the inflation rate. So if long-term inflation is 3%, the expectation with equities is to earn over the long term a 9% annual return. Bonds are a way of financing corporations or the government again, and you are lending money directly to a company, and usually in $1,000 increments. So the company, in financing its business, can choose to give away a piece of the ownership and a piece of the earnings through equities, or they can borrow money from the public and pay an interest rate. Just as you would pay an interest rate on a mortgage or a car loan, a company can pay a fixed rate of interest. For example, a company could borrow money at 5% today, and generally the interest payments from the company are every 6 months. So every 6 months you get a check from that company for $25. At the maturity of the bond, let's just say 10 years, 10 years from now, you get your principal back. So you buy the bond for $1,000, you get $50 interest every year. And at the end of the bond period, the term of the bond, you get your $1,000 back plus the last interest payment.
Quick question. So someone's asking if you can make the presentation bigger. Would you be able to do the present slideshow?
How's that?
Is that let us know, Daniel, if that's good. Or I think you can continue, and I'll. Oh, great. Okay, it looks good.
Okay. And if you have the slides, all of these slides are in the deck that Ari can send you. Now, like a stock, you can sell the bond in the open market. And if you sell the bond in the open market before its maturity, you may get more or less than your $1,000. And we'll talk a little bit about this. This gets a little complicated here. But selling before maturity results in gains or losses. So if you have a bond that matures 10 years from now and you sell it in 5 years, the value of that bond, what you will get, could be more or less than $1,000. For long-term bonds, the goal is to provide income and returns of 3% over the rate of inflation. So again, if inflation is 3%, you would expect to get about 6% on any corporate bonds that you buy. Lastly is money market, which are very short loans, 1 day to 1 year. They typically don't involve price changes, and the goal is to provide liquidity and safety. The return on money market funds is inflation plus a very tiny bit to compensate you for risk. So those are the 3 primary asset classes that we're going to talk about. Now, we have a quiz here, so you have to answer this in your head, but Albert Einstein, at one time, they asked him what the most powerful force in the universe is, and he thought about it for a couple of minutes, and he didn't say E equals MC squared. Einstein said compound interest. So what does that mean? It means that if you invest $100 at 5% for 25 years, and then sell that investment at the end of 25 years, you will have $335. Some of that is the return of your principal. Some of it is the interest rate of 5%. And a large portion of that is interest on interest. So if at the end of the first year you have $100 and at the end of the year you have $105, then the next year your interest is on $105 at 5%. So the end of the second year you will have about $111, not $110. That's compound interest. You're paying interest on both the principal and the interest that you've already earned. That same $100 invested at 5% for 50 years, you would get a check for $1,146. Now the numbers start to get big. At 100 years, $13,000. And if you were lucky enough to do this when the start of the country, the start of the United States 250 years ago, invest $100 at 5%, you would get $19,830,000. So you only invested $100, but you're entitled at 250 years to $19 million. Now, let's say that when you came over with Christopher Columbus in 1492, 500 years ago, and you put your money in the First National Bank of North America at 5% interest, you put $100 in, then you would be entitled to $3,932,326,182,000. Okay, that used to be a big number. $3 trillion is becoming less and less of a number these days. So with all the talk about the budget. So compound interest is really where you make your money, earning interest on interest. Here's a simpler way to look at it. Here's you invest $1,000 for 20 years, which is the light green bar going across. And if you have interest without compounding, so it's 10%, so every year they pay out the interest instead of reinvesting it, then you would have a total of close to $3,000 at the end of 20 years. Now, if you compound it, instead of paying out the interest every year, you would have a total of a little over $7,000. So you can see at 20 years, the biggest component of that by far is the interest on interest, the compound interest. So let's look at the three different investments over time. So this chart goes back 20 years, and the dark blue line is the portfolio of stocks. It's basically the stock market. So 20 years ago, if you invested in the largest 500 companies, you would earn a return of 155%. So more than double your money, 100%, you double your money. So more than double your money at the end of 20 years. If you look at the light blue line, that is government bonds. So you can see the return there. You would earn a return in government bonds of about 8%, a little over 8% over that 20-year period of time. Now, the interesting one is the purple line, and that's money market funds. Money market funds are designed to track inflation. And you can see what happens. There's a couple periods of time where interest rates for money market funds spike. And that generally occurs when there's some type of a major crisis going on. So you can see that when we had the meltdown back in 2008, interest rates peaked. They came back down again, roughly to where they are today. And then we had the market again was disrupted when we got into the coronavirus. And you can see interest rates came back down again. If you put your money in money market funds over that period of time, you're basically getting your money back. Another way of looking at stocks and bonds and money market or cash investments is the return. Now, this one is over from 1970 to 2019, so almost 50 years. So stocks over that period of time earn 10%, bonds earn 7.4%, and cash, money market, earn 4.9%, roughly where inflation was. Now, if you take out taxes at roughly a 20% rate, you would have earned 8.2% because you pay tax on all the income you get from these investments. Under bonds, you would get 4.1%, and on money market, 2.6%. So the taxes reduce your total return, depending on your tax rate, by 20 to 25%. The last one is kind of interesting. because many people as a goal want to earn a return greater than inflation. Any return greater than inflation is what they call a real rate of return. So you take the rate of return that you earned and subtract out the rate of inflation, and what's left is the increase in the purchasing power of your money, the real rate of return. So by the time you take out taxes and inflation, stocks are really the only investment that enabled you to beat inflation. You can see that bonds, there was about 4% inflation. So your return after taxes and inflation is zero. And if you invested in a money market, you had a negative rate of return. In other words, the money market, the returns on the money market after taxes did not keep up with inflation. So you need to keep that in mind when you invest, and bear in mind, whenever you invest in anything, you have a partner with his hand in your pocket, and that's a partner with a big hat, a big stovepipe hat, and a red, white, and blue suit, and his name is Uncle Sam. So Uncle Sam will take a piece of any income that you earn. And this chart shows it. Now, spend a little bit of time on stocks here, and why do people invest in stocks? And basically the stock market over the last couple of years has been growing like crazy. So I picked 3 stocks out here just because they're interesting to talk about. So the first one, the dark line, again, is the stock market, the Standard & Poor's. So over that 20-year period, your investment in the stock market is up about 139%, more than doubling over a 20-year period. Well, how about if 20 years ago you invested in Microsoft? Okay, good company. Microsoft has been doing very, very well recently. Well, it did a lot better than the stock market. So instead of 139%, you would have a return of 400%, 404%. So over 4 times your investment. If you put $1,000 in there, you would have north of $4,000. The interesting one in there, and it shows you the risk of investing stocks as well as the benefits. The pinkish line there is GameStop, and you may or may not be familiar with it. They're the retailer that sold video games, and they did very, very well in 2008. As a matter of fact, the stock price peaked back in 2008, and then people stopped buying video games in stores, and they started to move online. GameStop went back up again, and right now, GameStop is down 65% from where it was when they first went public about 20 years ago. So if you sold at the peak in 2008 or 2014, you would have made a lot of money. If you bought at the peak in 2008, you would have lost a lot of money. And GameStop has been bouncing around quite a bit recently because people are trading based on the perception of GameStop on the different social networks. So if you followed the market all this year, GameStop was really something to see. It went up very high. It's not shown on this chart. Went up very high and came down very, very fast. So you can make a lot of money in stocks. You look at Microsoft, and some of it's fairly consistent. And you can lose a lot of money in stocks. And you can see that with GameStop. So just to show you the risk and return of stocks. Talk about bonds again. And again, this gets complicated. I teach a finance class on occasion. And the people I teach, it takes us a couple of classes for them to understand how bonds work. So I wouldn't feel bad if you don't understand it after one night. You can read up on it, or you can take a class in finance. So you invest $1,000. And you have a choice of buying bond A, which will give you $1,050 after 1 year. Bond B pays $1,100 after 1 year. So which bond should you buy? Well, I think most people would say 1 year period of time, I put $1,000 in, I can get $1,100 from bond B. I'm going to buy bond B, which I think the rational investor would do. Now, let's say somebody else wasn't as smart as you, and they bought bond A, paid $1,000 for it, just like you did for bond B, and they decide 6 months into it that they're going to sell it. Well, if interest rates on bond B are paying $100 a year or 10%, and bond A is paying 5% or $50 a year, and you go to sell bond A when other people will buy bonds that will pay them a 10% yield, then your bond is worth less than $1,000. A 5% bond in a 10% market, if you go to sell it, will give you less money. So again, it's kind of a tricky concept because bond prices move inversely to interest rates. Interest rates go up, bond prices go down. Interest rates go down, bond prices go up. Last time we'll look at the historical rates and returns, and you can see the volatility, which is a form of risk of stocks and bonds and cash. So for this, I went back 40 years, and the Standard & Poor's returned 12.9%, the stock market 12.9%. Treasury bonds returned 7.6%, and Treasury bills returned 4.6% compound annual return. Now, the standard deviation measures the amount of movement of the different asset prices. So the one to look at is the dark blue line, which is the stock market or the Standard & Poor's 500. And the standard deviation measures the variance, the differences from the average rate of return. So if I add one standard deviation to the average return of 12.9%, you get 27% on the high side, and you get minus 3% on the low side. So 2/3 of the time, you'll be between 28% and minus 3%. Stocks are very volatile. You can see it there. You can see the various crashes there in the early 2000s, a few years later, and you can see the peaks there. So if you're buying stocks, you're buying volatility. Bond prices change, so they're less volatile. They give you a lower rate of return, but less volatility. And Treasury bills give you the lowest return, but the most stability. So you're trading off, and this is the fundamental trade-off in investments of risk versus return. Stocks have the highest return, but also the highest variability or risk. Treasury bills have the lowest return, but also the lowest variability or risk. So let's talk about different kinds of risk. There's what they call default risk, which is primarily a loan. So if you loan your best friend $1,000 for 5 years, default is a question of whether or not they can pay you back, give you that $1,000 back at the end of 5 years. Okay, if they don't, then it's called defaulting on the loan. The second thing, and we talked about this a little bit, is inflation. Inflation if you have an investment that pays you $1,000 a year for 10 years, well, how much is that $1,000 worth 10 years from now? How much is it worth in real terms, in real purchasing power? And it's your return less the rate of inflation. If inflation is low, your $1,000 will have higher purchase, will have the highest purchasing power when inflation is low. If inflation is high, 10 years from now, the purchasing power of $1,000 might only be $500. So inflation eats into your real rate of return. Loss on investment, I just showed you the chart. Stocks go up or down. If they go down and you sell it, then you have a real loss. And you saw the volatility. You saw the blue line moving up and down. And then you have just the basic concept of volatility, which again, if you focus on the blue line from a couple slides ago, at any point in time, your $1,000 could be worth $900 or $1,000 or $1,200 or $12,000. So it's the uncertainty or risk. And if you take a higher risk, you should be getting a higher return. So thinking about risk, and we get into the concept here of diversification, message number one is some risks look big and dangerous, but you can solve that risk problem by owning diversified portfolio of stocks or bonds. And I have an example of that. Message number two, market risks or macro risks. So I can deal with the uncertainty of investing in one company, but the market is going to move, and if the market moves up or down, it's going to drag all the stocks with it. So it's hard to eliminate market risk. And the third message is risk can be measured, and we talked about it. Risk primarily is measured by the standard deviation of returns. So here's a little video on diversification. It goes for about 5 minutes.
In previous videos, we have hopefully convinced you what you should not do. Don't try to beat the market by picking stocks. And definitely don't pay someone big money to help you pick stocks. Now let's turn to a rule that tells you what you should do. Investment rule number 3. Diversify, diversify, diversify. And choose funds with low fees. Diversification allows you to reduce your risk by spreading your investment across many different assets. The great thing about diversification, it's a free lunch. It reduces your risk without reducing your return. Don't put all your eggs in one basket. I'm sure you've heard that saying before. Yet when Enron, one of the most successful and seemingly safe energy giants, when it collapsed, its employees had about 60% of the retirement savings in Enron stock. Many employees who once had been millionaires, they retired with next to nothing. So let's be clear. It may sound loyal, but investing in the stock of your employer, it's never a good idea. 2 reasons. First, you should never have a substantial fraction of your wealth in a single asset, whether it's your employer's stock or not. Second, investing in your own employer really does put all your eggs in one basket. If the company goes down, you lose your job and your retirement savings at the same time. Terrible idea. Moreover, modern financial markets make it easy to diversify. Our favorite investment is index funds, low-fee funds that simply mimic a large market basket like the S&P 500 or the Wilshire 5000. But don't limit your diversification to stocks from your home country. That's called home market bias. It's quite easy to diversify internationally by buying an international index fund or by buying more big multinational companies. Once again, diversification is a free lunch. By diversifying, you can lower your risk without reducing your return. Since stock picking doesn't work, you shouldn't pay someone to pick stocks for you. We've said that already. And we've said that our favorite investment device is a low-cost index fund. But even among index funds, some have higher fees than others. So look for funds with low fees. Vanguard often has lots of good choices of low-fee index funds. But in any case, make sure you check. Fees might not seem like a big deal, but they're one of those things that adds up over time. If you invest $10,000 today, for example, and you hold it in a mutual fund that charges 1% fees annually, then in 25 years, you'll have about $57,000, assuming a market return of 8%. 57,000, that's not bad. But if you invest the same $10,000 in an index fund that charges 0.2% in fees, a very reasonable number, then in 25 years, you'll retire with just over $70,000. Do you really want to give up nearly $13,000 for nothing? The bottom line is that when it comes to investing, simple is the way to go. If your employer offers a 401k plan, sign up. Invest a constant fraction of your paycheck regularly and put the money in a low-cost index fund. I know there's a few sophisticated folks out there who maybe they're not yet convinced. Maybe your friend advised you to buy stocks in December to catch the January effect. Or they told you that stock prices fall on Mondays. Maybe you've heard that people aren't perfectly rational and that the market is filled with anomalies that efficient markets theory has trouble explaining. Next up, we're going to dive into the findings of behavioral finance to see whether we can profit from irrational behavior and market anomaly.
Just really quick, there was a question in the chat
Yep.
saying, how do you feel about robo-investing applications like Acorns?
I'm not familiar with Acorn, to be honest. I mean, there are some the mutual funds out there. There's a mutual fund with every investment strategy in the world where they use artificial intelligence to pick stocks. And it's possible. I mean, I think what you'll find over time is there is no one particular approach that will outperform the other approaches, at least on a risk-adjusted basis. So what you saw before, and I've got another chart on this, if you take higher risk, you're probably going to get a higher return. So that doesn't specifically answer the question, other than I would not take all my money and invest it in any one strategy, especially a new strategy, because they tend to start off high and create problems down the road.
I also just wanted to add to that, since this is actually a question that came up at a similar presentation last week. The presenter then, his opinion was that he felt that really the fees for robo investors were not super worthwhile, because he felt that they really didn't do anything that you couldn't do just by Googling and looking stuff up yourself. So that was his opinion last week. Certainly it can vary from one person to another, but I just wanted to also give that additional perspective, since this is a question we actually had pretty recently. I remember he talked about.
Yeah, there are investment strategies that I think make sense over a long period of time. And we're going to cover 401k plans, so we'll talk about them then. There are what they call target maturity funds, which invest the assets of the plan based on your age and anticipated retirement date. So let me jump into this, which is the concept of diversification. So the idea of diversification is that if you invest in more than one stock, more than 10 stocks that are diversified by industry or diversified by other means, you will hopefully get the same return, but mitigate your risks. So you've got 3 stocks here, just to show you how diversification works. One stock went up 10 and down 10, up 10, down 10. And the other stock went down 10, up 5, down 10, up 5. So it's got the same returns. It's the exact inverse of the first strategy. those stocks are what they call negatively correlated. So negative correlation means when something goes up, something else goes down. Positive correlation means when something goes up, the other thing probably goes up, very often similar amounts. So what the idea with diversification is to find negative correlations without giving up return. So this chart just works on a theoretical basis, but you can see that at the end of the 10-year period, the one that goes up 5 and down, up 10, down 5, and down time, they have the same average return, and they'll give you $1,246, both of them, at the end of that period of time. But the stock that goes up 2.5% per year, every year, will actually provide you with a higher rate of return. So you can see the blue line, the orange line, they end at the same place, but the gray line, which is a simple 2.5% compound rate of return, actually gives you a higher rate of return, actually gives you a higher account balance because you're eliminating the dips. And that's what you're trying to do with diversification, is take some of the dips away from your investments. This is a complicated chart, but if you have an interest in investing, it's something you take home and look at it. The idea here is to find investments that give you a high rate of return, but have a low correlation. And the numbers across the top. So you look at the first line, which is S&P 500. That's essentially the large cap companies in the stock market. And then these are the different investment types that they analyzed here. So UH is mid cap. So they're medium-sized companies, small-sized companies. MSCI is the same thing with European and Asian stocks. So Europe, Asia, and Far East. Large, small, and emerging, which are very small companies. And then you have different bonds, aggregate bonds, different treasuries, long and short. And TIPS are inflation-protected bonds, and real estate, and gold, and commodities. So the idea here is to get a high rate of return, minimize your volatility, so you have annual standard deviation on the far right column. So you've got annualized return. So large cap stocks, medium cap stock, and then small cap emerging markets are the highest, the winner over this period of time, which is January through February, January 2008 to February this year. So the small companies provide an 11% return with the highest level of risk. It's exactly what you would expect. High return, 11%, risk, 21%. The Standard & Poor's, the large cap index, provides a 10% return, but substantially lower risk. The areas in here show the correlation. So if you're constructing a portfolio, you would look at high returns, and then you would look at the standard deviation of the returns, and you would look for negative correlations. So for example, the Standard & Poor's 500 has a negative 40% correlation with SHY. So you go over here and you say, okay, SHY is a 1 to 3 year treasury. So you are diversifying your portfolio, you're eliminating some of the volatility, but you're giving up a substantial amount of return. So that does lower your risk, but it also will significantly lower your return. So you want to find something that doesn't have that dramatic an impact on your portfolio and get into different asset classes as described here, stocks, bonds, diversify, and you look at commodities. Okay, they actually provide a negative return and they're negatively correlated. So you go through an analysis like this in constructing a portfolio. It's kind of an interesting chart. If you, again, if you have an interest in finance, it's something to look at when you get back to your room and take it with you. So let me go back up here. So diversification, the idea is to reduce risk by spreading across many investments. Specific risk is the risk associated with a single firm. So in the video, the moderator talks about Enron. And the problem there is that Enron was the major investment in the 401k plan. And it was also the company that people worked for. Well, Enron ran into significant financial problems. Number of their executives went to jail for fraud. So if you invested in Enron, which a lot of people did, you got wiped out. So that's what they call specific risk, is the risk associated with any one particular company. And then market risk is the risk of the market moving up and down. If you go back to the one chart and remember the blue line, the market goes up and down. That's called systemic risk. So you can diversify away from specific risk. So instead of investing just in Enron, you invested in another 20 companies, then you would not have gotten wiped out when Enron went under. But the market may have gone up or down. So you would have protected yourself against the specific company risk. It's harder to get away from the risk of the market in total. And then timing risk is, if you remember the GameStop chart, there were a couple of very high peaks there. And you don't want to put all your money in the market at once, because you might be buying into the peak and you might watch your money disappear as it did in the GameStop. So again, you manage risk by diversifying by number of stocks, by industry. So you don't necessarily want to buy all tech. You might want to buy tech and retail, or tech and retail and automotive. You can invest by size of company. So we showed you the results for small, medium, and large. Small companies did slightly better than mid and large. You can invest in different countries. So you can invest in the US, you can invest in a mutual fund that invests in European companies. You can spread your investments over time to minimize the risk of a GameStop or an Enron, and diversify by asset class. So for example, stocks, bonds, and cash, different asset classes. And this just shows you that it doesn't take a lot to diversify away specific risks, the risk of a single company. So if you won't own about 18 stocks or even 15 stocks, you can pretty much eliminate the risk of one company. Now, you're still going to be left with the market risk, but you're going to minimize the specific risk. So that curve moves down pretty quickly. You get up to 5 stocks, you've achieved a lot of diversification. You've diversified away a lot of specific risk. And what you have left is the market risk, which is where you want to be in a well-constructed portfolio. Talk a little bit about mutual funds or ETFs. They're basically the same thing. They're structurally slightly different, but your money is pooled with other investors. You own shares of the fund, not the securities. So if you go to Fidelity and buy shares in their technology fund, you own shares in a fund. You don't own shares of Microsoft or Facebook or the securities underlying it. The mutual funds own the securities. You own the mutual fund. Shares are traded daily. They have professional money managers. They have different investment objectives. There's thousands and thousands of mutual funds. And the last I looked, there were over 6,000 different mutual funds and ETFs out there. Most of those have slightly different investment objectives. Most of those have different portfolio managers. You can also invest in index funds. Now, index funds for a beginner are probably the place to be because an index fund basically buys you the market. So the returns that I showed you over time, the Standard & Poor's, that's basically the market. And you as an individual can't buy shares in 500 companies, but you can buy one share in an index fund managed by Fidelity or Vanguard and get exposure to the entire market. So your return in an index fund is the same as the return in a market. And there are index funds in all the different asset classes. One benefit of index funds is they have very low fees compared to paying somebody to manage your money. Index funds are primarily automated investments where what they're buying is designed to replicate the market in total, and they're heavily regulated. So there is a prospectus which discloses all the nuances of the investment. The returns are disclosed online every day, or you can look at the returns in the newspaper, but they're heavily regulated and they send out a lot of reports and a lot of good information for you. Again, there's different kinds of mutual funds. We won't get into it, but there's an equity fund, which is stocks. There's a fixed income fund. We talked about bonds. And a balanced fund is a fund that gives you some exposure to both equities and fixed income. And then if you have some short-term cash, you're saving up to buy a car, you can put your money in a money market fund. The returns today are minimal on short-term investments, but they're a safe place to park your money while you're waiting for something longer term to pop up. So just run through a couple of these and you can answer these mentally. Are you diversified or not? You put $10,000 in a 5-year CD yielding 3%. Diversified or not? Well, you're not. Why? Because you're exposed to inflation risk and you have some minor risk of default. Buy $10,000 worth of Amazon today. Amazon's one of the most valuable companies in the world. If you buy Amazon, are you diversified? And the answer is no. I mean, you've taken on all specific risk. So you've got the risk of Amazon and you also have the risk of the market in general. You buy $5,000 in Amazon and Apple, are you diversified? Well, better than just Amazon, but not as good as you should be because they're both basically in the same industry. You buy 5,000 each of Amazon and Merck, well, you've got some diversification because you're in different industries there. You're in e-tailing, electronic and retail, and Merck is pharmaceuticals. Buy 3,000 of Amazon, 3,000 of Merck, and 4,000 of Treasury note. Well, now you're getting more diversified because you've introduced another asset class. You've introduced the fixed income asset class that will moderate the ups and downs of just having stocks, but it should reduce your return over time. Buy $10,000 of Fidelity S&P 500 today, you're diversified, you've diversified away the specific risk. So if one of those 500 companies falters or 10 of them, you'll barely notice it. But you do have the market risk. You're left with the market risk. Buy $6,000 of an S&P 500 fund and 4,000 of a Treasury note yielding 3%. Similar again, you've got more diversification there because you're in different asset classes. You've taken the specific risk away from the stock market. So you are diversified there. I think you're pretty well on your way there. You're giving up a big return on the $4,000 in treasuries, but you're going to have a lot less volatility. And then we'll talk a little bit on the next one where you put your money in a 401k plan. So how do you decide whether to invest in a mutual fund and what type? Well, if all your money, if you're taking money and it's all going out the door, or you're saving money to buy a car in 3 months, really what you need is a short-term investment or just put it in the bank. Okay, you take what's left there because you don't want to expose yourself if you have a short-term need. How familiar are you with investments? Okay, and that will determine whether you should go into individual securities or mutual funds or index funds. There are a very large number of very smart, very highly paid people whose sole job it is to pick individual securities. So it's very hard to beat the sophisticated investor. It does happen. Generally, any advantage goes away quickly over time. Look at your investment horizon. Again, if you're buying a car, don't put some money in the stock market, put it in cash. If you're saving for retirement, you have a different window. You have a 40-year window there. So you can afford to be riskier. You can afford to put more money in stocks because over time, and you saw all the different charts, stocks should provide a higher return than alternative assets. Can you tolerate risk? Over time, and you don't have to watch the returns on a daily basis. And what do you have for other assets? Is this your only asset, or do you have multiple assets out there? So again, different way of looking at it, diversify your portfolio, different asset classes, different securities. Again, most people your age should be dealing with mutual funds or ETFs or S&P 500 index funds. Stay within your comfort zone, dollar cost average. So you want to put your money in over time to avoid investing at the peak, and time horizon, match your horizon with your investment. So long-term, you can take greater risk. Short-term, you don't have a lot of time to recover. So when you get a permanent job, create a financial plan. And there are people out there who can help you create a financial plan. But take a look at your money coming in and money going out and see what's left. Take what's left for savings and use that to build an emergency fund, a short or intermediate horizon investment, low risk, and then what's left you put into a higher risk. And I strongly encourage you, if your employer has a 401k plan, you should go in a 401k plan, and you should go in as quickly as you can. So what a 401k plan will do for you is it will provide you an array of investments. So a typical 401k plan might have 15 or 20 different investment alternatives. They will allow you to pick how much money you want to put in each of those different alternatives. Again, if you're not that comfortable with investments, I would advise you to take advantage of what they call target date funds or target maturity funds. And those funds invest in different mutual funds to get diversification. So you've got specific risk taken care of. They will give you different mutual funds. So they will have tech funds. They might have conservative funds in there. But there is a fiduciary choosing where to put the money. And they will probably allocate your money in the higher risk end. So somebody at 25 should be at least 80% invested in a target date fund on the aggressive side. And that will automatically be done as you age. You get to 35 or 45, they will gradually reduce your risk exposure by reducing the stocks in the plan and increasing the bonds. And as you get to 60 or 65, you would be probably 90% invested in fixed income as opposed to where you started 40 years prior, 100% or 80% in stocks. So you should get in a 401k plan. It enables you to dollar cost average 401k plan. The contributions and your earnings are tax deductible. So if you make $20,000 and you put $4,000 in a 401k plan, you're only taxed on $16,000. You pay the tax when you withdraw the money 40 years from now. There are penalties if you take it out early. So don't put money in a 401k plan you're going to need. But if you can put it away and you have a long-term horizon, put your money in a 401k plan. Most companies, this is a major benefit of a 401k plan, is the employer will match. Typically, the match is structured so that if you put in 6% of your pay, so if you're making $50,000 and you would put in $3,000, 6% of your pay, and the employer will match 50 cents on the dollar for the money you put in there. So $3,000 becomes $4,500. So you have an automatic 50% return on your contributions. So that's something you should take advantage of from day one. You get choice of mutual funds, and they're totally diversified. And we talked about target date funds. My suggestion is that's what you do. Take advantage of it. Let the professionals manage your money until you get your legs under you. Delaying contributing to the 401k plan can hurt you, and because you're losing the benefit of compound interest. So another way of looking at compound interest. So if you're putting money in $5,000 a year and earning 5% on that money, the first grouping, the far left, the blue and the orange, after 40 years, you will have $600,000 in your fund, and you will have put in $200,000. So you get a 3-to-1 multiplier. You put in $200,000 over 40 years, you get $600,000 back. That's compound interest. The second one, look at the gray and the yellow. The gray is what you would have if you start putting money away at age 45, where you only have 20 years to go. So you would have, at the end of 20 years, about $160,000. You will have put in about $100,000. So you get about a 1.5 to 1 multiplier. And the last one, if you put money in for 10 years, you can see that the return on that money is not significant. So at that point, if you're not going to put money in the 401k until you're 55 years old, you're going to have to look elsewhere for your retirement money, because you're going to have to fund all of it on your own, as opposed to using interest to fund it. So anybody have any questions? Anybody have any open issues? No?
All right. If there aren't any questions, I think we're at the end here. If some question does come to you, you can, of course, feel free to email us. Let me put our email address in the chat. There you go. So please do email us if you have any questions that come up or anything that you would. Oh, question I see. One is, can you tell us how to access the recordings? For that, let me share with you our website. And I see there's a second question. I will get to that right after I share the website. So I'm going to share a link to our website, and at this link you can, why is it not loading? Just a moment. Let me just copy from earlier. Let's see if this works. Okay, here it is again. So when you go to our website, you can actually click on past events. And then there are some that say virtual lecture, and those you can view the recordings there. This one we'll try to post hopefully within the next week, but we do have others available. And then I see a second question. This is for Edmund. Do you have any tips on how to get started? Do we start with a service like Vanguard, for instance?
Yeah, I would encourage you to use a sophisticated mutual fund manager, a Vanguard, Fidelity, T. Rowe Price. There's a lot of good ones out there. Vanguard tends to be the cheapest, and they provide very good services and a lot of funds. If you're going to work, the best way for you to get started is to go in your 401k plans. Sometimes there's a waiting period, maybe 3 months or 6 months. Soon as you're eligible to join, you should join it. Again, you can turn the management of that money over to a professional. As you get more comfortable with investing, then you can either take some of that money out of the target date fund and invest it, stay within the 401k, but pick your own funds. And if you become really sophisticated and want to pick your own stocks, then you can do that too. You'll probably not be able to do that in the 401k, but you can do that. So I think the first thing is get your feet wet, use a 401k. The second one then is start to look at different funds, make decisions on your own within the 401k. And then the last one is, okay, if you're smart enough and want to put some money in the market on your own, go ahead.
For next, Daniel, I see you had your hand up.
Yes, thank you. I am an international student, and my situation might be a bit atypical. I have the money for my 2 years in the United States now, and I wonder how could I invest it, because I will need to use that money to live during the next 2 years. So it's not retirement; it's kind of the opposite. I have the money for 2 years now.
We talk about time horizon, and 2 years is a relatively short time horizon.
Mhm.
And I know the market has been going up like crazy the last 4 or 5 years. The market also goes down like crazy. So if you need that money in 2 years, you need to invest it conservatively and invest it so that you will have that money at the end of 2 years. If you really want to gamble with it, then maybe you take a small piece of it and invest it in a mutual fund. But 2 years is a short time horizon, and things do happen. So if you need that money in 2 years and you need the money you're putting in back, if you want to preserve principal, then don't put it in the stock market.
Yep, definitely the big point to take away is you should generally try to avoid investing money that you can't afford to lose. And it sounds like you were saying that this is money that you will be needing for sure in 2 years. Is that correct? Daniel, are you still there?
But that's
Yes, it's correct. I'm sorry.
yeah.
Okay.
Then just put it in the bank.
Yeah, even just like a savings account, it'll accrue a little bit of interest. It's admittedly not spectacular, but really it sounds like you want to play on the safe side to make sure that you don't potentially lose a portion of, or a large portion of this money that you'll be needing. I hope that answers your question.
Great, thank you. Yes.
I see a question here on BC's 403B tax currently. The 403Bs work like 401ks. So any money that you put in there reduces your taxable income. So again, if you're making $50,000 a year and you put $4,000 in the 403B plan, you will only be taxed on $46,000. One advantage of the BC plan is that it is a very, very generous match. So you really want to get the match. It's a multiple kind of a match. It's not 50 cents on the dollar. You want to get in and maximize the match. It's really a good one. So, and the match is not taxable to you. The match is taxable when you retire and start drawing the money out.
Mhm.
So it's a good plan, and you really need to take advantage of it.
All right. Any last questions? Maybe we have time for one more question if there is one. Or if there isn't, we can wrap up here.
I guess we're all set. Okay, well, thank you for paying attention. It's a nice day out there, and I appreciate you giving up your time. Hopefully you took something away from this. If you go through the slides and you have questions, you can go to Ari, or you can, I'm in the BC directory, you can send me an email.
Yep.
And we'll get back to you.
Yeah, for sure. Oh,
Somebody wants to buy cryptocurrencies?
yeah.
That's, yeah, okay, that's a good one to ask later. I don't own Bitcoin. But there are services you can use to get your Bitcoin. Or if you're a professional basketball player, you can take half your salary in cash and half in Bitcoins.
Yeah, I'm not sure if we have any professional basketball players in the room though tonight, unfortunately.
Or professional football players work too.
Oh, NFL turned you down.
NFL turned you down? Oh,
Yeah, but yeah, definitely cryptocurrency is a very big question, certainly that will take more than 2 minutes to answer. So please, feel free to email Edmund or myself, and we'd be happy to talk with you about that more.
it's something we're all going to have to get familiar with because it's coming. And it's coming as a currency too. You can buy cars. Certain, I think Elon Musk will let you buy a Tesla with a Bitcoin. So it's not widely accepted, but it's becoming more accepted than it has been. And I think it's coming on. So we're going to all need to get familiar with it.
Everyone take a look into Dogecoin. I've heard a lot about. That's not an actual recommendation. That's a joke, in case it was unclear.
Well, you can buy a piece of a cat. I mean, you can buy pieces of anything these days. But before you do that, go and look at the tulip bubble in Holland in the 1600s and see what happened there.
Yeah. Well, I think it's 5:15 now, so I think we're definitely out of time. I know there are some more questions people had, but we have to wrap up for now. So please do email us. I'll put my email in again, just one more time. And if you even want to send an email, we'll be sure to reply to that as soon as we can. Even if you just email me, I can forward it to Edmund if it's something that he'll need to answer. But for now, I hope everyone has a good rest of your night, and thank you for coming to the presentation.
Good luck with exams.
Yes, for sure.
Take care. Bye-bye.
Bye.